Good afternoon, everybody. Welcome to the Columbus Metropolitan Club. My name's Julie Keckstein. I'm with PNC Wealth Management. I serve clients across the street. You can only imagine how geeked out all the bankers are to be here today. Today's forum is brought to us with the support of J.P. Morgan Chase, Columbus Dispatch, and GBQ, each of whom is represented by their associates and friends here today. Help me thank them and welcome Darcy Congrove, Managing Director of GBQ, to the podium to introduce our program. Darcy?
Thanks, Julie. GBQ is a public accounting firm and consulting firm, and we're based here in Columbus serving entrepreneurial clients, and all of those clients are very interested in what's going on with interest rates, as I'm sure we all are. There's always strong interest in what representatives of the Federal Reserve are saying, and I'm sure today will be no exception. We are very excited to be sponsors of the Columbus Metropolitan Club, supporting the mission of engaging the community in conversations that matter to the health and vitality of everything that we do here in our region, and are proud to call Columbus our home as one of the firms that's founded here. It's my honor to welcome the President of the Federal Reserve Bank of Cleveland, Loretta Mester. And Tim Farron, business reporter at the Columbus Dispatch. Loretta's going to start us off with comments from the podium and then join Tim for conversation. And we thank you both and look forward to hearing what you're going to talk about.
Thank you very much.
A warm welcome to both of them. Thanks.
Thank you, everyone, and good afternoon. I want to thank the Columbus Metropolitan Club for the opportunity to speak to so many of Ohio's business leaders. And I see several Cleveland Fed directors in the audience. I want to thank them and all the attendees for taking time out of your busy schedules for being with us here today. Now, as president of the Federal Reserve Bank of Cleveland, I place a high premium on the information I gather from business leaders like you, who are willing to share what you're seeing as you navigate through the ebbs and flows of economic waters. Your insights are enormously helpful to me as I formulate my views on the economy, views that I express when I go to Washington to participate in meetings of the Federal Open Market Committee, or FOMC, which does not mean Fruit of the Month Club. It is the body within the Fed that sets monetary policy for the nation. More than 100 years ago, Congress designed the Federal Reserve as a decentralized central bank, with 12 reserve banks across the country overseen by the Board of Governors in Washington. The Federal Reserve System's structure helps ensure that Main Street perspectives are considered around the FOMC table. It's a true strength of the system, and it's one worth preserving. Now, before we move on to the question and answer part of today's program, I would like to open with a brief discussion of my economic outlook and monetary policy. And as always, the views I'll present are my own and not necessarily those of the Federal Reserve System or my colleagues on the FOMC. It's now been over 6 years since the official start of the economic expansion. Supported by extraordinary monetary policy accommodation, the U.S. economy has made significant progress since the darkest days of the global financial crisis and Great Recession. Underlying economic fundamentals have strengthened, resulting in an economy that's been able to sustain growth at a moderate pace over the past 5 years. We began 2015 with a slowdown in output growth. Much of this year's slowdown reflected temporary factors, including the harsh winter weather and the labor disputes at ports on the West Coast. Measurement issues also likely played a role. For the past 6 years or so, output has tended to grow less in the first quarter than in other quarters, and government statisticians are taking steps to improve the methods used to seasonally adjust the numbers. The recent monthly economic data, as well as information gleaned from my business contacts, suggests we're seeing a rebound in spending in the second quarter. Although yesterday's report on retail sales in June was weaker than analysts expected, it came after strong May sales. Consumer spending, which represents about 2/3 of output, picked up in the second quarter, supported by growth in personal income and continued improvement in household balance sheets. Based on projections from the U.S. Energy Information Administration, the drop in gasoline prices is estimated to be saving the average household about $700 this year. Perhaps not surprisingly, consumer sentiment is very good, at levels not seen since before the financial crisis and Great Recession. Business sentiment also remains solid, but industrial activity has been weak in recent months. The drop in oil prices compared to a year ago has led to reduced investment and some dislocation in parts of the domestic energy sector, and this is affecting growth in certain regions of the economy, of the country, including parts of eastern Ohio. But the U.S. is still a net importer of oil, and so the benefits of lower energy prices in terms of consumer, business, and local government spending will ultimately result in a net positive for the U.S. economy. Another factor weighing on firms exposed to international trade is the appreciation in the value of the U.S. dollar since last summer. A stronger dollar means better terms of trade for the U.S. consumers and businesses, which is a positive for a growing economy in the longer run. But in the near term, dollar appreciation is putting a drag on U.S. export growth. The recent stabilization in energy prices and slowdown in dollar appreciation mean that both drags should lessen over time. On balance, I expect that after a weak first quarter, growth will pick up at an above-trend pace over the rest of this year and next in the 2.75% to 3% range. Now, I want to acknowledge there are risks around this forecast. I've incorporated a slowing in the pace of growth abroad, including China, but the magnitude of the slowdown remains uncertain. I'm also assuming that the situation in Greece will have a limited impact on the U.S. economy because our direct exposure via trade and banking is limited. Greek debt is held mainly by the public sector rather than private sector investors. And the European Central Bank has tools to contain spillovers to broader financial markets. Now, the Greek situation remains unresolved, but we had some positive news earlier this week. And the risk of a very bad outcome with sizable effects on the global economy is not high enough to change my modal outlook for the U.S. economy of moderate above-trend growth, which will support continued positive developments in labor markets. Over the past year, the economy has created an average of 245,000 jobs per month, and non-farm payrolls are now 3.5 million above their previous peak before the recession. The unemployment rate is 5.3%. Down sharply from its peak of 10% in 2009, and down 0.75 of a percentage point over the past year. A broad array of other labor market indicators have improved significantly over the past few years, including the long-term unemployment rate and the unemployment rate that includes discouraged workers and part-time workers who would rather work full-time. In addition, we're now beginning to see signs that wage growth is picking up. Year-over-year gains in the Employment Cost Index, a comprehensive measure of wages and benefits, rose from under 2% in the first quarter of last year to over 2.5% in the first quarter of this year. The delay in wage growth shouldn't be a surprise. Typically, wages tend to accelerate only after we've seen sustained improvements in the labor market. Some analysis we've done at the Cleveland Fed shows that in the last 3 expansions, job gains in industries that pay above average hourly earnings contributed more to total private sector gains as the expansions continued on. In my view, the totality of evidence suggests that the economy is at or nearly at the Fed's mandated monetary policy goal of maximum employment. This isn't to say there aren't longer-term challenges facing the labor market. Workforce development is a key issue. As a country, we want to ensure that people can enter and remain productive members of the labor force, to raise our standards of living, and to make us more competitive in the global economy. However, monetary policy is not the tool for addressing this important issue. It is better served by policies focused on strengthening and increasing access to education and training. Here in Ohio, we have also seen improvements in labor markets since the recession, but there are longer-run challenges as well. The state's unemployment rate has fallen sharply from a peak of 11% in December 2009 to 5.2% in May, which is half of a percentage point lower than a year ago. Firms have been adding jobs. It's true that the pace of job growth in Ohio is slower than in the nation. Over the past year, jobs have been growing somewhat less than 1.5% in Ohio, compared to over 2% in the U.S. as a whole. And while the U.S. employment is now 2.5% higher than its pre-recession peak, employment in Ohio has not quite reached that milestone. So how should we interpret this performance? Well, it helps to put it into context. First, the pace of job growth in the state is now well above the pace we saw during the last expansion when employment in Ohio was flat. Second, job growth in the state has been slower than the national pace since the mid-1990s. This is not a new phenomenon related to the Great Recession. It partly reflects slower population growth in Ohio and Ohio's higher share of jobs in manufacturing, a sector that has been experiencing a long-run decline in employment. Manufacturing accounts for about 15% of private sector jobs in Ohio, compared to about 10% in the U.S. Those shares are down about 7 percentage points since the mid-1990s. Within this bigger context, we can characterize the improvement in Ohio labor markets over this expansion as being pretty good, but at the same time recognize there are longer-run challenges as manufacturing continues to transform itself into a sector with higher productivity production processes requiring higher skilled workers. The Columbus metro area is generally faring better than other regions in the state. As you know, Columbus benefits greatly from a highly educated workforce and a diversified industry base. This has contributed to broader gains in employment across multiple sectors in the Columbus area and puts the Columbus economy in a stronger position for sustainable growth. In addition to maximum employment, the other part of the Fed's dual mandate is price stability. Inflation has been below the Fed's 2% goal for some time. Headline inflation has been running at about 0.25% so far this year. Excluding food and energy prices, which tend to be volatile, so-called core inflation has been running about 1.25%. Low inflation partly reflects the sharp drop in energy prices, as well as the appreciation of the dollar, which makes non-petroleum imports cheaper in the U.S. These downward pressures are starting to wane as oil prices and the value of the dollar have started to stabilize. Would I like to see higher inflation numbers? The answer is yes. Am I reasonably confident that inflation will gradually move back to the Fed's 2% objective over time? The answer is also yes. Supporting this view are above-trend economic growth, continued positive developments in labor markets, and the stability in measures of inflation expectations and some of the alternative measures of inflation, like the Cleveland Fed's median CPI and the Dallas Fed's trim mean PCE inflation. Of course, my economic outlook is dependent on appropriate monetary policy, so let me turn to that now. As the FOMC has said, in determining the appropriate path of monetary policy, we assess both realized and expected progress toward our dual mandate goals of maximum employment and 2% inflation. So policy is not on a preset course. It depends on our read of what incoming data and economic information mean for our economic outlook and the risks around that outlook. It's well accepted that monetary policy needs to be forward-looking. Because monetary policy affects the economy with a lag, rates will need to begin to move up from their very low level before we have fully reached our goals. Moreover, with rates having been at zero for a sustained period, there's the potential for increased risk to financial stability from excessive leverage or from investors taking on risks they're ill-equipped to manage in a search for yield. The FOMC continues to carefully monitor financial markets for signs of these types of emerging problems, and so far, so good. The FOMC anticipates that two criteria need to be satisfied before it will be appropriate to raise the federal funds rate: further improvement in the labor market and reasonable confidence that inflation will move back to its 2% objective over the medium term. Now, according to the FOMC's June economic projections, 15 of 17 participants anticipate that it will be appropriate to begin to move interest rates up sometime this year. My own assessment is that the economy can handle an increase in the Fed funds rate. A small increase in interest rates from zero is not tight monetary policy. And with the economic progress we've made and that I expect to continue, monetary policy can take a step back from the emergency measure of zero interest rates. But I understand that others might like to see more confirming evidence before commencing a rate increase. My colleagues and I on the FOMC are all committed to promoting our dual mandate goals of price stability and maximum employment, but we may have different views about realized and anticipated progress towards those goals and about the potential costs and benefits to changes in policy with respect to achieving those goals. While financial market participants are particularly focused on the timing of the first rate increase, when it comes to monetary policy, timing isn't everything. The FOMC meets 8 times a year, and the difference in lifting off from zero interest rate a meeting or two earlier or later is not significant. More important for macroeconomic performance is the expected path of policy beyond liftoff, because expectations about the future path of policy can affect today's economic decisions. According to the FOMC's current assessment, even after the first rate increase, monetary policy is expected to remain very accommodative for some time to come, with rates expected to move up only gradually to more normal levels, and with the decisions about the path depending on incoming information on the economy's performance. One benefit of the gradual approach is that it'll allow us to recalibrate policy over time as some of the uncertainties surrounding the underlying economy in the post-crisis world, like the potential growth rate, are resolved. Just like the timing of liftoff, the path of policy after liftoff will depend on how economic developments unfold. There's always uncertainty around projections of growth, unemployment, and inflation. If incoming economic information materially changes our outlook, we'll adjust the funds rate up or down as appropriate. But while our policy path is not predetermined, because the future is not predetermined, one thing is certain. The Federal Reserve is committed to setting monetary policy to promote our congressionally mandated goals of maximum employment and stable prices. Thanks for your kind attention.
While you get yourself hooked up, maybe I'm being irrationally exuberant, to quote a former Fed chairman, but I am really very excited to be here to talk to you today. I followed the Fed and the Cleveland Fed for a long time. The studies, as you mentioned, the recent one came out, they're always well-reasoned, well-researched, well-written. One of the things I'd like to talk about today is I know the Fed can seem very mysterious to a lot of people. Not to a lot of people in this room, probably, but a lot of people in the general public. A colleague attributes that to Fed speak. Things like liftoff, things like quantitative easing, things that the average guy on the street isn't exactly going to know what's going on. So in appearances like this, how important is it that you kind of demystify the Fed? And or is it all about the twin goals of the Fed?
So I think communication is very important. I think the Fed has been trying over the last 20 years or so to improve our transparency. All fields have lingo, unfortunately.
Yeah.
I'm sure in the newspaper business you probably have lingo too.
Yes.
But we are trying to be as transparent as we can and try to explain the rationale behind our policy decisions. Accountability is very important for the Fed. And I think that it's incumbent upon us to try to be as communicate in a clear way as we can. Some of us are better at it than others. I did use liftoff in my remarks here, but hopefully people in this audience understood that I meant bringing interest rates up from zero.
Right.
But I do just ascribe to the fact that the Fed needs to be transparent. We want our policy to be understood. We want our rationale for our decisions to be well understood by the public. First, it's important for us to be transparent and held accountable because, we've been given this role mandated by Congress, and so it's incumbent upon us to do it. But for another reason is that if people understand our policy, it actually makes monetary policy more effective. So if people can understand the rationale, it helps actually make the policy itself more effective.
There's nothing to fear than fear itself.
I hope that I hope we don't create fear. I hope by our speaking that we kind of explain ourselves.
Exactly. Right. So you've been Cleveland Fed president for about a year.
About a year.
So what have you found that's unique about this 4th district that you're now?
So it's very interesting. So I came actually from the Federal Reserve Bank of Philadelphia, which is the third Federal Reserve District, into the fourth district.
You're moving up.
Exactly, moving higher up. And one of the things that struck me was actually the similarities in the economies, because Philadelphia's district had the same issue about transforming itself from a manufacturing-based economy into one that is moved into services, eds and meds. And so when I got here, of course, I knew the economy before I got here, but it was also striking about how the same kind of issues that the Philadelphia district faced were faced here. So I found that less of differences and more similarities that I thought was of interest.
Huh. And so how does, you found that the Fed, perhaps the Cleveland Fed, how does that affect here, Columbus, Ohio?
So I really am very much in favor of this decentralized central bank aspect of the Federal Reserve. So I think it's very important that we have Federal Reserve banks distributed across the country. And I think that the Cleveland Fed, well before I got there, is a great representative, a great business to have in your area. We produce a lot of information on the local economy. We were talking at lunch about some of the things that we produce. You know, our hope is that we can explain the economy. We gather information from everyone in this room, people in this room, to try to inform our views at FOMC. So, you know, I find it very valuable to talk to as big a swath of business leaders as I can across the district, because it really helps us evaluate what's going on in the economy. As we've talked about, again at lunch, the data comes in with lags, right? So it's great to have the data, but you have to also be talking to people to see what are they really seeing on the ground and what are the challenges that they face. So we take that role very seriously. We gain a lot of information from the district, and we're hoping to provide some information back. We have a community development group at the Cleveland Fed, which I think is first rate. And they're researching issues that are very relevant to the regional economy, foreclosures, workplace-based programs to help education. So I think we can provide information, but we also, you know, are very grateful for people to provide us with information too.
Some of that information, I'm sure, includes the skills mismatch that's been impeding job growth.
Yes.
There's a group among those kids out there who don't have the skills. They're not employed and they're not going to school. In years past, they might have been absorbed into the manufacturing sector, which, as you noticed and noted, isn't growing. What do we do about those kids?
Well, so this is, again, one of these longer run challenges. The number of, you know, low-skilled jobs, and not just in manufacturing, just in the country, right? There are fewer of them, right? And what that really means is we have to focus on making sure that we allow for equal opportunity to actually go into education. Now, does it have to be college education? Perhaps not. It can be other kinds of training programs, but we have to be able to do that. I gave a talk actually at a Cleveland Fed conference in Pittsburgh, the Policy Summit, where it's a community development conference where we had a lot of people in the audience, and they said the same thing, that education is a continual process, and it's not all STEM. You know, you have to teach soft skills as well as that, so people can understand what it means to be in the workforce. And I think as a country, right, it's kind of our responsibility to figure out the best programs, right? We have everyone has limited resources. We need to find the most effective programs, and there is a lot of research going on to be able to do this, but more comprehensive programs are also
absolutely. Otherwise, these kids will be a drag on the economy, on businesses. We won't get tax money from them. It'll just, but I think, and their lives will be
exactly. I mean,
destroyed. Most of all,
we as policymakers, we want to focus, and of course, this isn't a monetary policy issue, but just in general, right? I think we have to try to do the best that we can for our country and all of its people, and try to, you know, figure out ways of solving these kinds of really hard problems.
Absolutely. You mentioned, of course, that Columbus has recovered rather well from the recession, and other places in Ohio, not so much. What is it about Columbus? Bill Lafayette quite often asks that question rhetorically. But what is it about Columbus? Is it just the Ohio State and education
So
facilities?
I think
or-
that's actually very helpful. If you have a university, a high-quality university, that can help because one of the big issues is, do you retain the people who go to the university in the
Yes.
community, right? And so you can train them, and if they leave, that's a problem. But Columbus has been able to do that. I think the partnerships between university and entrepreneurs is something that can help, right? There's a lot of that going on here. I think that just having, and we know from a lot of studies that if a more educated workforce actually helps the people at the less educated end of the work. Everyone is, it's like, the boat rises with,
Right, the rising
And
tide,
so these kind of cohort effects or whatever you want to call them, another lingo, I shouldn't use that. But anyway, these kind of, I was going to say externalities, that's no better. But anyway, these kind of like broad, factors.
We'll break you of these habits.
Yeah, thank you very much. These kind of broad, I don't know, Doug Campbell tries to break me of this all the
right.
time, but he hasn't been successful so far. But anyway, that can help,
Absolutely.
And I think that's one of the things that Columbus has going for it.
You've also mentioned that although labor markets have improved, wages haven't really increased as well as we might like. There was a recent study out of the Cleveland office talking about that. When do you think this is going to change, if it's going to change?
Right. So I would say we're seeing signs of now some acceleration in wages, which is good. I would also say that usually you don't see wages starting to pick up until you get very close to full
Yeah.
employment. So it shouldn't have been that surprising that it took some time, right, for us to beginning to see wages accelerate. And so I think we're beginning to see that. Some people want to see a little more of that before they're convinced, but you can look at some of the data and you can see an acceleration going on.
Although longer term, that's been a continuing problem over the last decades, is it not?
Well, I think, we'll go back to some of the things that we talked about in terms of workforce development and skill sets, and those are problems that need to be solved in order to be able to sustain, higher wages.
My very next question, some people are arguing that monetary policy has contributed to income inequality. What do you think? Is that true?
All right, so I'll talk about it firstly. So some of the extraordinary things that the Fed did included bringing the interest rate down to zero. Okay, and so that's going to have a disparate impact, right, on
Absolutely.
savers versus borrowers, for example.
Yep.
Retirees who are dependent on sort of fixed income kind of financial instruments versus people who have access to the stock market, perhaps higher income individuals. So there are distributional effects of monetary policy.
Sure.
And in particular, when you get interest rates down to zero, they really become more apparent. On the other hand, right, had the Fed not taken those extraordinary measures, I think everyone would have been worse off. I think it was necessary to take those kind of extraordinary measures. And I think that now, right, as we go forward, right, it's time to get away from the emergency level of interest rates and bring things back to a more normal level.
Many people see the Fed as having kind of come to the rescue, ridden in with its policies. There, of course, has been a lot of talk about rate increases come September. The International Monetary Fund has been saying, can you wait until next year? And you talked a little bit about that in your talk. Is it likely to happen in September? Do you think it'll be next year? I won't tell anybody.
Okay, so
What do you think? Let me rephrase it. Should it come later this year?
Okay, so I don't speak for the FOMC. I'm just on it. I'm a participant. Okay, right. So what we're doing is we're assessing the progress towards our goals, both realized and anticipated. We've set up the two criteria that we think we need to see, anticipate will need to be, gone, further improvement in labor markets, right? And reasonable confidence in inflation is going to move back to 2% over the medium term. Different participants on the FOMC have different views about that because we look at the data, we look at our information from our districts, we look at information internationally, and we may have different views about that. So we go into every meeting with an open mind and a discussion, because I want to hear what my colleagues are seeing in their areas as well, right? So we have this discussion, and then the committee gets to, comes to a collective judgment about what's best for the economy. So I can't tell you, actually, right? Because I don't know, right? We're
Sure.
going to assess the information as it comes in. In my view, the economy can support a small increase in interest rates. But that's my view, and others will have different views.
Okay. So you mentioned the first rate increase. Would that be then leave it alone for a while? And what would your recommendation be?
Okay, well, as the FOMC said, we anticipate it's going to be a gradual, right, increase in rates back to normal. But again, what another Fed lingo that has been used is data dependency. We're dependent on how the data comes in on the economy, and we'll make our assessments as we go through time. The current assessment is that it's going to be a gradual path of interest rates up, because that's what we think the economic information is telling us is what's going to happen. But everything has uncertainty. When you're doing an economic forecast, there's uncertainty. It could be that the economy starts growing faster, and inflation moves up faster, and then we might want to, a higher path and a steeper path. Or we could get information that things are weaker than we thought, anticipated, and then we'd want a flatter path. So it's really going to depend on how the economy evolves over time.
I've got a couple of more questions, and in a few minutes we're going to go to audience questions, which is a CMC tradition. There's been a lot of activity in Congress about, completing the circle here, about the Fed and transparency, and there's an audit the Fed legislation. You've been fairly vocal in opposing that. Why? Do you think we're already very transparent at the Fed, and
Okay, so
why go further?
no, I'm a fan of transparency. Okay, so I do believe the Fed should be transparent. I do think we need to be held accountable. I view audit the Fed. Now, audit the Fed is a misnomer, because the Fed is audited,
Yes.
right? Our financial statements are audited. We put out information on the assets we hold in our portfolio, and in a number of ways we're giving information about our portfolio. What I view audit the Fed as, and why I am opposed to it, is that it's really a way of politicizing monetary policy decisions. This is about having an audit of monetary policy. And what we know from many, many studies, both here and abroad, is that once politics, right,
Don't go there.
affects decision-making in monetary policy, it can lead to worse
Yes.
policy decisions for the country. So having an independent institution setting monetary policy away from perhaps political interests, short-run political interests, is a better way to go, because it results in better policies. It's not really about not wanting to be transparent. It's about wanting to leave the Fed independent. At the same time, allowing independence on monetary policy does not mean we shouldn't be held accountable for those decisions. And today, Janet Yellen's up doing her semi-annual testimony as one way of sort of providing information to Congress about performance of the economy, decisions about monetary policy, and future, what our anticipated future. So there is accountability there, and that's why I kind of don't think we want audit the Fed. I think it would result in worse policy for the nation.
Very good. I'm going to have one more question and then throw it open to you folks. A little bit of fun here. I'm told you're an opera fan.
I am an opera fan.
And so let's compare operas to economies.
Oh, okay.
To what kind of opera would you compare, say, the U.S. economy or Europe or China? Are we talking Wagnerian, full of Sturm und Drang, or Gilbert and Sullivan operetta with frivolity?
Interesting. Good
Irrational
question.
exuberance in those?
That's a good
What do you
question.
think?
Okay, so I remember actually sitting in the opera at the Ring Cycle, because I was in New York, sitting and listening to Das Rheingold. And it struck me of how much sort of the current crisis, financial crisis, kind of was in that opera. So, Wotan basically had organized to build Valhalla, a house that they couldn't afford, right? They made this really bad deal, right, with the giants to build the thing. And then
So should Janet Yellen's theme song be The Flight of the Valkyries?
Yeah, exactly. Hey, that wouldn't be bad. And then they basically reneged on the deal, and then he had to steal gold to actually pay off the contract. So there's a lot of similarities there. Okay. However, you know, if I were going to compare today's economy, I think I would pick Magic Flute. Yeah, because the Magic Flute, for people in the audience who kind of know the story, is basically about mankind going from chaos, right, into superstition and then into sort of enlightened reason. And through a lot of trials, right? They have to progress through these trials. So I think about what we've done over the past 6 years as sort of like, we've had a lot of trials, the economy's had a lot of trials, and now I think we're getting to what I hope is the more enlightened age where we kind of have reason and understanding of what went on and learning. So if I were going to pick an opera, I'd pick the Magic Flute.
And there's all sorts of references to the Illuminati in the Magic Flute, as there is in the dollar bill. So there you go.
I hadn't thought of that, but you know, good point.
Okay, it's time for audience questions, so please step up to the microphone. We'll want you to tell your name, ask your question, and as they say on Jeopardy, please say it in the form of a question and not a long editorial comment. So.
Thanks for that reminder, Tim. And thank you so much, Loretta, for being here and providing so much insight for us today. We are certainly a world economy, and our U.S. economy is impacted by many things, and not the least of which can be currency. As the dollar begins to reach parity nearly with, or should I say the euro begins to reach parity nearly with the dollar, how much do you factor in those kinds of things as the Fed takes a look at all of the various things that impact our economy with the international factors that you might use?
Okay. That's an excellent question. So, you know, the appreciation of the dollar over the last year certainly has hurt export growth. So as a short run, near-term phenomena, it certainly has hurt companies that have exposure to trade. It's hurt companies with multinational operations. And that's been one of the drags that we've seen, right, on growth at the beginning of the year and, you know, going into the second quarter as well. Right, but if you look at the dollar, it's begun to stabilize somewhat. And so as that stability happens, right, those drags are going to lessen over time. So we certainly talk about international developments at FOMC meetings. We factor them in when we're thinking about U.S. output growth, for example. We're going to think about the trade sector. We're going to think about growth abroad relative to the U.S. because that's going to feed into our forecasts of the international trade sector. So we do take those kinds of things into account. The value of the dollar, of course, we don't control, right? But we take it as sort of a condition, one of the financial conditions that informs our forecast going forward.
Hi, thank you for being here. So we've been talking a lot about Greek debt nationally and internationally, and I did the math, and so if they estimate global GDP at about $73 trillion, and both Greek debt and Greek GDP at less than 400 billion, that represents less than 0.5% of global GDP. Is there a disproportionate concern and discussion over such a tiny number?
So I think the Greek debt situation is more than just an economic situation. I think it's become also a political situation on Europe and the role of European Union and that. So in that sense, it's bigger than just the numbers and the adding up numbers. And I think that's why it's sort of has gotten the focus that it's gotten and has implications for the institutions going forward and the union going forward and the Eurozone going forward. As I said in my prepared remarks, right, my current assessment is that, right, it won't have big spillovers to the U.S. economy. So for example, we know that it's the public sector that holds most of the Greek debt. We know that banks are not that exposed anymore, right? In 2012, and earlier there was, but banks have taken steps to emerge from that. And also the European Central Bank, the ECB, has tools to limit the exposure, right, of other markets. And if you look at sort of what's happened in other financial markets since over the last couple of weeks, it looks like they haven't reacted as strongly as one might have thought, before. So my current assessment is that it won't have large spillovers, but it's certainly something that we're going to keep our eye on. And it is one of the risks that international developments is one of the risks that you factor in when you're doing a forecast for the U.S.
Maybe Apple can buy Greece.
Hello, President Mester.
Hi.
Correct me if I'm wrong, you're on the subcommittee for communications at the Fed.
Correct.
How will you quantify success or failure with regards to communicating with the markets, with the people of the economy, with regards to both the liftoff and the path thereafter?
So that's a really interesting question. I guess my feeling is that we're going to see volatility, right, around liftoff time. I wouldn't expect not to have a volatile. But our goal is to be as transparent as we can about the way we're thinking about policy so that, right, we're not surprising the markets. But, as I said, the world, life isn't predetermined, nothing's predetermined. So, again, we're trying to be as transparent as we can given, right, that we're not prescient, right? And that's how I gauge success, is whether we've been as transparent as we can about our current thinking. And I really respect Janet Yellen because I think she's done an excellent job of, telling it like it is, right? Where we can be transparent about policy, I think she's been so. And when, she says we're data dependent, I think that's what it is. There's uncertainty around any forecast. And so as the data comes in, we're continually assessing it. That doesn't mean we move our forecast around on any little piece of data, right? We gather data and we try to assess it relative to the current forecast. Sometimes it's material enough that it'll change our forecast. Sometimes it's not. So the way I gauge success is, do we convey, right, where the committee is and our current thinking on, economic developments and monetary policy? We're working on we're continually working this Federal Reserve on trying to be as transparent as we can in ways that are beneficial. So I think of this as a work in progress that, we haven't reached a destination. It's kind of a journey. And if you think about, it wasn't until, I think, 1994 that the Fed even put out a statement, right, after FOMC meetings about what its decision was. So we've come a long way. But I still think, there's other things we can do to try to increase our communication skills. Perhaps getting rid of jargon is one of them we should work harder on.
Hi, Bill Lafayette. I guess the obligatory 4th District question. In many ways, Columbus is the shining star of our region, and our surrounding economies aren't. So to what extent do you think the fact that our surrounding economies are so weak affects us? And are there any ways that you can think of that policymakers might leverage the success here to impact favorably economies there?
Whoa, that's a hard question, but an important question. Again, I really think that it's about skills and making sure that you can have these liaisons, entrepreneurship, and sort of fostering an environment so that you can innovate. And to the extent that we can think about programs that actually improve workforce development. We've had people tell us, businesses tell us that they are happy with training workers. They want to train them because they can actually get people that actually with the skills that they need in their job. But the problem is that when they train them, then they leave. And so there's those kind of things, are there good ideas about how you can maybe train not at an individual firm level, but at a broader level, right, to develop the skills that are necessary in a region, right? And there's work going on in those kind of ideas, and I think that can help. But you're right, Columbus does have the university here, which I think is a important attribute, and being able to retain graduates, I think is something that's important as well.
Good afternoon, I'm Meg Tieford. I wanted to hear what you thought about the housing market and whether things are now really taking off and maybe taking off too fast? Or what do you think about what's happening with housing?
So that's an interesting question as well, and important, given what we've been through, to know sort of what's going on in housing. So housing has actually still been a little bit disappointing, I would say, residential. We've seen signs of some tick up in existing home sales and new home sales, which is a positive. But in general, I don't think residential investment sector is going to be that strong a contributor to growth this year. On the other hand, we've seen multifamily housing doing fairly well. I certainly don't think it's growing too fast yet, but it's an area that we're looking at to see, how it's developing. I don't view it as some people say they think there's bubbles developing there. That's not my assessment. But I think there may be a longer run issue about whether people want to rent, right, versus own. And I think we don't know that yet, right? And to the extent that there may be changes in that, that's something we need to be thinking about going forward as well, is what's that mixture of apartment living versus owning a home.
There's been a lot of talk about millennials in particular, being affected by that. Julie, I think we're about done, yes?
Terrific. How enlightening. Thank you so much for being here.
Thanks for having us. Thank you. Thank you.
Remember, you can view and share all of our forums on CTV Columbus Television, WOSU and PBS affiliates statewide through the Ohio Channel, and anytime on columbusmetroclub.org via YouTube. Before we conclude, let me thank our sponsors, JP Morgan Chase, GBQ, the Columbus Dispatch, Loretta, Tim. Thank you. Enjoy your day.